Greetings, salutations, and howdy to you all. I'm KT with Tosha Global Analytics. Tosha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate, and finance trends, and the policies that shape them. So, in our first video of this series, I shared the salient facts of the property, some terminology, some definitions, and gave you some insight into the market where the property was sold. I gave you the general strategy, the measure used to define the return, and rudimentarily described the process I shepherded the properties through. In the second video, we looked at the repositioning strategy a bit more closely, covered some issues that we looked for in the model return, and then moved forward toward the purchase and the forecast of the eventual sale. So we're going to dive into a comparison of the projected numbers and the returns for the actual sale in just a moment. So buckle up, buttercups. There are real numbers in just a bit. But first, let's take a look at the remodeling part of the repositioning strategy. Based on the market at the time and what the seller had already done, the plan included updating the kitchens and about half the units, and some of the cosmetics in the bathrooms were also going to be updated, and that totaled just a bit over $250K. Updating a percentage of the mechanicals in units ended up being another $250K. Amenity upgrades, you had about another $250,000 or so. So the total for everything ended up being just over $1 million in rehab costs, or about $4,500 per unit. And now, if you've seen some of my other videos, you know how to confirm what the value of something is by capitalizing the revenue, which is usually the gross rent multiplier times the value benefit in rent for that particular item, and that gives you the capitalized value. So in this case, without reviewing that process in depth, I can tell you that the added value for those updates and upgrades worked out to be about $12K per unit using that method. That $4,500 per unit investment was well worth it if you realize the expected return. Of course, it was a forecast at the time, and a way to show you how it really panned out. However, we bought the asset for $68,100 per unit, so we needed to make about $80,100 at the time of sale to make that $12K, at least based on a nominal return, not adjusted for inflation or anything else. So, by the way, when I say we bought it, I mean the REIT bought it, but the firm I was with at the time became the facilitators of it all. So, anyway, okay, so that leads us into talking about the model return. A couple key things to understand when you have a property like this. You have certain options, to restructure the investment during the holding period. You can invest some more into the asset at some point and kind of reset the holding period, start over from the beginning again. Borrow against the increased equity and lower your costs. Your out-of-pocket equity position. So you have less money actually invested in it, and redeploy that capital somewhere else, or you can sell the property early if that makes sense. In some cases, it does. Okay, so you have to look at the various contingencies and see how that affects the model. Also, you need to do some sensitivity analysis on the model. Ask yourself, what if the first year's rental increases miss the target? Can it be made up in year 2 or 3? You have to kind of determine these things. So how much does it take to still make the minimum target? You always have to have that in mind. There are a lot of considerations. So think of it this way. The analysis doesn't end. It just morphs throughout the process, depending on the needs or concerns that need to be addressed at that time. Okay, so in the last video, I stated that the target return was normally about 18%, but I ended up sweetening up the return to a 23% IRR forecast through year 5 based on everything that we were going to do to the property, and that included stacked washers and dryers, which was not technically a part of the real estate, and we didn't have as reliable a data on what that should increase rents for. Obviously, if you have units without stacked washers and dryers, and if you include it, you should be able to get more for that. But anyway, I presume some viewers were shocked by that 23% IRR number. Again, about 16% or higher is very typical for these deals. And I just found a property in this one where the firm that I was working for, their strengths and the typical strategies were really going to outperform most of the competitors. So it was just the right property for our programs. Uh, so how did I do on the cash flow projections for each of those years? Well, that seems like a logical question, and what happens within the holding period always includes some curveballs. You track performance, tweak the budgets, and generally manage and verify the effectiveness of the strategies in place. You have to be ready to change if it's warranted, and that's what we did. So here's the year-over-year comparison for the first 3 years, and the fourth prorated by the 3 completed months of income that we had before closing. And so okay, we outperformed. That's fantastic. It was a great managed team, an improving economy, and what I liked personally was it validated that my forecast was solid and the upgrade plan did do what it was really intended. So, before we dive into the final numbers for the closing sale, I ask you to please like and subscribe and really help the channel out. Okay, so here we go. Let's do a comparison of the summaries between the forecast of what would happen with a 5-year hold and the actual, which ended up being about 3 years and 3 months total. Some basics here: the original hold, the 5-year plan, but the REIT was divesting early, and it just needed to liquidate holdings in the U.S. And so it's just after 3 years. 3 years and 3 months is what it totally was as far as our ownership. I'd mentioned that selling early, which we call disposition, by the way, in the business, meant there was a prepayment penalty due on that mortgage. So this is not like residential mortgages. You've contracted for a mortgage that was supposed to collect X amount in interest, and you leaving early doesn't negate the expected interest in this type of mortgage. So by selling early, somebody pays for that, pays a penalty for that early sale. And by the way, the way it was handled is a little interesting. I don't wish to share too many details about it, but we have to account for it here. So just know that it was nearly $2 million that ended up being effectively lowering the sale price for selling early. So here's the full discounted cash flow, or it's technically summarized. And again, we call this a DCF. And here it is showing the projected returns throughout the whole period. We have the NOI after replacement reserves, the equity position that the REIT paid into the property, the mortgage funds and debt service costs by year, the original purchase price, and the projected disposition price and seller's expenses at the end. So a reminder that we had 3 years of interest-only payments, and then the debt service kicked up to the full annualized rate. So with that, I'd projected a 23.3% IRR. Really quite solid returns. A little sidebar here: if they had invested in the asset without any kind of financing, the unleveraged IRR would have been only 11.6%. So that shows you the benefit of having leverage versus it being unleveraged. But 11.6%, honestly, that's not a bad return. But clearly, that's far less than leveraged via the mortgage, especially the one we ended up using. So, by the way, the cash flow alone averaged a return of over 10% after year one. So the 11.6 clearly reflects that. If you compared it to stocks, and a dividend payment of over 10% would be outrageously high. So also somebody might note in taking a look at this, we had a 75% LTV quote. Again, LTV is loan to value, and we borrowed 76%. LTV on the asset. Well, that's because the LTV that was used for the loan was established via the appraised value that was slightly higher than what our purchase price ended up. So, I had mentioned in the previous video that our firm had not won the competitive bidding process in the final round. The winning firm they had to back out. So, well, they had done their own underwriting, came to nearly the same conclusion on the present value. So we were very much aligned. Both firms expected the appraisal to be about where it ended up. So it wasn't really about that. It was about our firm getting great financing and having ready access to capital, and the other firm did not have either or both of those in order to close the deal. And before I show you the actual DCF at disposition, please take a moment and like and subscribe. Okay, so here we have many of the same numbers that you've already seen. The NOI is a bit different than the projection, as I noted earlier. It includes 3 months worth of income in the fourth year. It also includes a prepayment penalty of nearly $2 million, as shown here. The actual disposition price of $20.4 million is shown. Therefore, the real selling price is effectively different. Again, without sharing too many details here, the adjusted selling price to reflect the penalty is about $2 million higher because of that penalty. Also, we have the disposition costs, etc. So how about the returns? Well, we have the quote actual unquote IRR that relies just on the stated disposition price of $20.4 million, and that ends up 19.1% IRR. Very solid. However, when you look at the adjusted selling price to include the discount for the prepayment penalty, then the IRR should be 25.3%. And here I also show the unleveraged IRR, again, as before. Because the asset sold earlier than it was planned, it didn't benefit from the remaining cash flow and the full reversion like it should have. So the unleveraged IRR was hurt as well. And lastly, I happen to show what the price per unit was. I had mentioned that we had to hit a mark of $80,100 per unit to justify the costs, and we ended up over $100,000. So very good return. So though the returns were actually hurt by selling early, they were still above what the equity partners wanted and required in this case. You see, here's a little inside baseball on how private equity REITs work. First, they don't earn money like money managers do when stocks are involved. It's not so much about charging fees. It's about paying a, quote, promised return, unquote. So a private equity REIT may advertise that they will pay 14% IRR on a particular investment if you choose to invest capital with them, but they really intend to earn about 20%. If the investment earns the 20% as planned, then the investor earns their 14% and the REIT holder keeps the, quote, extra, unquote, 6%. So they and actually most investment houses typically use what is called a waterfall model. And that models how the payouts occur for equity positions. So, some of it is the priority order for paying the returns, who gets paid in what order, and some of it is what percentage they are paid at. So referencing that 20% IRR return as an example, some parties may earn a lower percentage, like the 14% I referenced, while others may earn effectively quite a bit higher return than 20% based on the waterfall structure. It's the entire asset that earned the 20% when I reference that. So here, at the end of part 3, we've covered the salient facts of the property, some terminology definitions, some insight in the market there in part 1 video, as well as the general strategy, the measure used to define return, and I described the process. Then in part 2, that second video, we looked at the repositioning strategy a bit more closely, some issues we looked for when we modeled the return, and then moved toward the purchase and forecast of the eventual sale. In this part 3, in this video, we covered the projected numbers and the returns from the actual sale. Now, we could stop there, but we have one more video coming. The next video will cover what happened with the asset later, because it was purchased from us in 2017, but it was sold again in 2021 for an even higher return than we earned. So buckle up, buttercups. You ain't seen nothing yet. Catch you in the next video.